Welcome back to the channel. I'm AlgoBot, and today we're taking an educational look at a MetaTrader 5 expert advisor called Atr Stretch Reversion. This is a mean reversion approach, sometimes described as a rubber band fade, and it leans on three familiar tools working together: an exponential moving average as an anchor, the average true range to measure volatility, and the relative strength index to confirm exhaustion. By the end of this video, you'll understand exactly how the strategy detects an overextension, how it times an entry, and how it manages risk. Remember, this is for educational purposes only and is not financial advice. Let's start with the big picture. ATR Stretch Reversion is built on a simple observation that many traders study. Price tends to travel away from its average and then, fairly often, snap back toward it. The strategy uses an exponential moving average, by default a 50-period average, as the anchor or the mean that price is measured against. On its own, though, a moving average can't tell you how far is genuinely far, because a calm market and a busy market behave very differently. That's where the average true range comes in. The average true range measures recent volatility, and the strategy multiplies it by a stretch factor, 2 by default, to draw an upper band and a lower band around the moving average. When price pushes beyond one of those bands, the approach treats that as a statistically meaningful overextension rather than ordinary noise. The third piece is the relative strength index, a momentum oscillator, which the strategy uses to confirm that the move is running out of steam before it considers fading it. The rules are fully symmetric, meaning the logic for a short trade above the mean mirrors the logic for a long trade below it. This is a single time frame design that holds only one position at a time, which keeps the risk bounded and the logic clean. Every entry carries an average true range-based stop loss and take profit, and there's a break-even feature that moves the protective stop up to the entry price once a trade has moved a defined distance in its favor. In terms of who this style tends to suit, it's generally studied by traders who are comfortable with rules-based, counter-trend ideas and who understand that fading a move is a specific discipline with its own trade-offs. As always, trading involves risk, losses do occur, and nothing here is a recommendation to trade. Now let's walk through the exact logic, step by step. The strategy only acts on a freshly completed bar, so it waits for a candle to close rather than reacting to every flicker of price. It looks at two recently closed bars, the bar it calls the overextension candidate, and the more recent bar it calls the reclaim candidate. First, it computes the moving average, the average true range, and the relative strength index as of the just closed bar. From the moving average and the average true range, it builds two bands. The lower band is the moving average minus the stretch multiplier times the average true range, and the upper band is the moving average plus that same amount. With the default settings, that's the average plus or minus 2 average true ranges. For a long setup, the strategy checks three things in combination. First, the earlier bar's low must have pierced below the lower band, showing that price genuinely overextended to the downside. Second, the more recent bar must close back higher, meaning it closed above its own open and above the prior bar's close. That's the reclaim, a sign that buyers stepped back in. Third, the relative strength index must be below the oversold level, 30 by default, confirming that downside momentum was exhausted. When all three line up, the EA signals a buy, entering at the ask price. The short setup is the mirror image. The earlier bar's high must push above the upper band. The more recent bar must close bearish and below the prior close as a rejection, and the relative strength index must be above the overbought level, which is 100 minus the oversold setting, so 70 by default. When those align, the strategy signals a sell at the bid. Risk management is defined in average true range terms, so it scales with volatility. The stop loss sits 1.5 average true ranges from entry, and the take profit sits 2 average true ranges away, which is roughly a 1.33 to 1 reward to risk shape. On top of that, once price has traveled 1 average true range in the trade's favor, the break-even routine moves the stop up to the entry price. And because the strategy allows only one open position at a time, it won't stack trades. All of this is educational, and none of it removes the risk that any individual trade can lose. Let's read through the meta editor code on screen. At the top are the input parameters you can adjust in the tester. EMA period sets the moving average anchor, ATR period and RSI period set the volatility and momentum lookbacks, and stretch multiple, defaulting to 2, controls how many average true ranges away the bands sit. RsiOversold is 30, SlAtrMult and TpAtrMult define the stop and target in average true range units, and break-even ATR sets when the stop slides to entry. Now the long block. The Boolean long setup is true only when all 4 conditions hold together. Prevlow is below the lower band, so the prior bar overextended down. Sig close is above Sig open, so the reclaimed bar closed bullish. Sig close is above the prior close, confirming it reclaimed ground, and the relative strength index is below the oversold level. When that's true, the code reads the ask price, sets the stop loss 1.5 average true ranges below it, and the take profit 2 average true ranges above it, and calls trade.buy to place the order. The short block is the mirror. Short setup is true when Prev high is above the upper band. The signal bar closed bearish and below the prior close, and the relative strength index is above the overbought level. Then the code reads the bid, places the stop 1.5 average true ranges above and the target 2 average true ranges below, and calls trade.sell. Notice both sides use the same volatility scaled distances, keeping the rules symmetric. This is educational only. Let's bring this to life on the chart, walking through a long trade first, and then a short trade. The blue line running through the middle is the exponential moving average, our anchor. The 2 gray lines above and below it are the stretch bands, drawn at the moving average plus or minus 2 average true ranges. Underneath, in the subpanel, is the relative strength index, with the oversold line at 30 and the overbought line at 70. Watch the opening candles. Price starts near the moving average and then begins sliding lower, one red candle after another. On the 3rd candle, the selling really accelerates, and notice its low pokes beneath the lower stretch band. That's the overextension the strategy is waiting for on the downside. Price has traveled statistically far from the mean. At the same moment, look at the relative strength index in the subpanel. It has plunged into the oversold zone, below 30, telling us downside momentum is exhausted. But the strategy doesn't buy just because price is stretched. It waits for confirmation. The very next candle closes back higher, above its own open and above the prior candle's close. That's the reclaim bar, a sign that buyers have stepped in. With the overextension, the reclaim, and the oversold reading all present, the conditions are satisfied, and on the following candle the buy entry marker appears. The stop loss is placed 1.5 average true ranges below, structurally just beneath that fresh low, and the target is set 2 average true ranges above. From there, follow the green candles climbing back toward the mean. Price lifts off the lower band, pushes up through the moving average, and keeps advancing. Along the way, once the trade has gained 1 average true range, the break-even routine quietly slides the stop up to the entry price to protect the position. Price continues higher until it reaches the take profit marker, and the long trade closes at its target. That's the rubber band snapping back. Now the mirror image plays out to the upside. Price keeps rising until, on the 9th candle, it stretches above the upper band, overextending to the top side this time. Check the relative strength index again. It has climbed into the overbought zone, above 70. On that same bar, price is rejected, closing bearish and below the prior close, giving ground back toward the mean. Overextension above the upper band, a bearish rejection, and an overbought reading together satisfy the short rules, so the sell entry marker prints. The stop loss goes 1.5 average true ranges above, structurally just over that high, and the target sits 2 average true ranges below. Watch the candles roll over and fall back toward the moving average, and price works its way down to the take profit marker, where the short trade closes. In both directions, the idea is identical. Wait for price to overstretch from its anchor, wait for the market to reject that extreme with momentum confirming, then fade the move back toward the mean with clearly defined risk. Of course, not every setup behaves this cleanly, and losses are a normal part of any strategy. This walkthrough is purely educational. So that's ATR Stretch Reversion from top to bottom. We covered how it uses an exponential moving average as an anchor, how the average true range defines a genuine overextension through its stretch bands, and how the relative strength index confirms that momentum has run out before the strategy fades the move back toward the mean. We walked through the exact long and short rules, the average true range, base stop and target, and the break-even logic, and we saw both trades illustrated candle by candle on the chart. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like me to examine next. You can find more at www.algobot.live. And a final reminder, everything here is educational information only, not financial advice, and trading always carries the risk of loss. Past performance does not guarantee future results. Trade responsibly.